All right, the big news this evening, and let's begin with that, was the Q2 numbers for Reliance Industries, the bellwether really of India Inc. And the numbers have been good, beating estimates on pretty much all counts in Q2. They seem to have beaten the COVID-19 blues as well. And the crown jewel continues to be Jio with a stellar performance. In fact, let's go across to my colleague Ajay, who's bringing us a breakdown of all the numbers. Ajay?
Well, second quarter numbers of Reliance Industries were a strong beat in this quarter at a time when expectations were very low. They've come out strong as far as the net profit is concerned. The top line goes on a consolidated basis, and that is because a very strong improvement in two businesses of theirs, which is petrochemical. It's come out, profitability has improved, top line was very strong, and even Reliance Retail. Much more. We were expecting a strong quarter, but they've delivered stronger than what the street was actually expecting. And Jio has actually shown steady growth. It's a competitive environment. They've added a good amount of subscription numbers as well. ARPUs have actually gone up slightly as well, but it was a steady number. So Jio on big base or growing base is steady to positive. Retail has come back in a very smart fashion with higher profitability and top line growth. And petrochemical has done very strong lifting this quarter, and all three made up for the weakness as far as the refining end of the business is concerned. Refining, actually we were expecting around $6, they've come $5.7 as far as the GRNs are concerned. Even the EBITDA on refining is low. It is expected to be weak for some time. Everybody else is also going through pressure as far as refining cycle is concerned. Reliance is no different, despite of having one of the best refineries. But at least all the other three businesses are more than making up for the weakness in refining end of the business. So strong numbers, positive commentary from here on. It will be interesting to see how the stock reacts in trade when we open for trade on Monday.
Well, thanks for that summary, Ajay, of the Reliance Industries Q2 numbers. Now, ordinarily, we don't go into details of corporate results and individual companies on this show, but we are going to talk about the Q2 corporate results this time around because of a very interesting perspective. So far, 31 of the top 50 companies, the Nifty 50 companies, have announced their results for the second quarter of the year. And it is a very exciting trend that is emerging. Now, when we look at the trajectory of economic recovery in India, we look at a host of factors. Sometimes it is how many cars are selling, or how many people are taking flights, or what the government's quarterly GDP data is, or what the GST collections are like. Corporate results are a very, very significant and strong indicator because some of the most respected companies of this country declare their numbers. These are very authentic data points in that sense, and they point to a steady resurgence and recovery, which deserves to be looked at more closely in terms of sustainability. But first, before we get to that analysis, let me go across to my colleague Poonam, who has put together a snapshot of how India Inc. performed this quarter. Poonam?
Well, if we look at the Q2 results, well, it's been a strong earnings so far, with more than 50% of the Nifty earnings so far reporting results which are above estimates, and close to around 30% of the Nifty earnings have reported in line results. It's a broad-based performance across sectors, be it FMCG, consumer, IT, financials, healthcare, cement. However, the performance by the auto sector is slightly mixed. In fact, if you look at the key takeaways, well, pent-up demand has been seen across FMCG and the consumption space. Rural demand continues to outpace the overall urban demand. Discretionary spending is still under pressure, and there is more business and demand coming in from the Tier 2 and Tier 3 cities. Hiring activity has been resumed by banks and the IT companies, and several IT companies have given hikes as well as increments. Technology Pack reported strong deal wins. Companies upgraded the guidance as well as positive outlook coming in from most of them. In fact, the auto performance was mixed. There was strong passenger vehicles demand, but CVs is yet to fully recover. Also, there is pent-up demand coming in from most of the auto pack. Festive demand is fairly strong, and also preference for personal transport has boosted auto demand. Higher cost, of course, impacted Hero Moto as well as Maruti. In terms of the FMCG pact, rural continues to outpace urban. Double-digit growth coming in from Britannia, Asian Paints and Nestle, and discretionary spending is still under pressure. Banks have seen improved collections, positive asset quality commentary coming in from most banks, and also positive commentary on growth coming in from Kotak Mahindra as well as HDFC Bank. Telecom has seen strong revenues. There has also been high data consumption and impressive margins. Steel continues to report strong earnings as well. The question is, will this strong earnings momentum continue?
Yeah. All right. Thank you for that, Poonam. Poonam there has put it together very well, talking about how Q2 is looking and why these quarterly numbers have such interesting indicators. Let me take that ahead with our panel this evening. I have with me Mahantesh Sabarad, the head of Retail Research at SBICAP Securities, Siddhartha Sanyal, Chief Economist and Head Research at Bandhan Bank, and Ajay Bagga, market expert, also joins us on the show. Welcome to all of you. Mahantesh, let me get your take on the premise that we've laid out. Do we have enough data to summarize what this quarter looks like for India Inc. and by extension what it looks like for the recovery in demand, in consumer trends and for the Indian economy?
So, Tamanna, one interesting trend that you have highlighted here is that the results are better than expected. Now, I'll take that and extend it to say that, yes, we have now enough results come in to really tell us that results are indeed going to be better for the whole universe as a whole. As we go forward, I think there would be upgrades that will be coming in not only from the analysts per se in terms of earnings upgrades. I would reckon that even credit rating upgrades are due pretty much soon. So to answer your questions, is there enough data that has come in the form of the results of the Nifty companies? I would say yes. The best would have been coming in from the IT companies so far.
All right. Mahantesh, let's go a bit beyond IT, because if you look at the broad trends, there's IT, there's auto, which is a little mixed. There's FMCG, which is robust and was expected to be robust. And let's look at BFSI as well, or banking sector. Now, if I look at these four buckets as sort of representative of the larger picture in the Indian economy, would it be safe to say that the worst that was feared has not taken place in Q2? A lot of pent-up demand did come in and fuel these companies to a better than expected performance.
Yes, you are right. But then pent-up demand has come in for automobile companies. You cannot say that pent-up demand has come in for, let's say, IT companies. You cannot say that the festival season has boosted the banking sector per se. Each of these sectors have their individual plays. If you look at banking, for example, there has been a support that has come in from RBI. The NPA worries that most banks had are actually relegated or deferred to the subsequent quarters. We know that from how results have been announced by the larger set of private banks. On the IT front, we have seen that they have done massively well in this digitization wave that is sweeping across the globe. And IT companies are actually globe-facing; they are not India-facing companies. And from the automobile perspective, one good part is that most of these auto companies have posted year-on-year growth in terms of their sales. And therefore, despite the pent-up demand being there, the year-on-year growth tells us that they have indeed done well enough to capture the resurgence of demand or resurgence of economic activity that we are witnessing right now.
You made an interesting point about banks, and let me take that across to Siddhartha Sanyal. Mr. Sanyal, great to have you on the show again. Is the Q2 picture a realistic one? You could argue that in some places it was merely pent-up demand, and of course compared to the first quarter, which was a complete washout because of the lockdown, things are going to look better Q on Q because of a weaker base. people who had to postpone purchases are making them now. In the case of banks, as was mentioned earlier, you don't really know the extent of trouble that is coming their way because of the moratorium that has been kicked down the can. Is this truly a representative picture?
Well, it will be unfair to call this particular quarter's number as not realistic, because these are hard numbers and people have actually seen quite a bit of bounce back from the extreme lows that we had seen in the first quarter. But having said that, the important point here to note is that if you see consumer confidence in the economy, especially in case of urban India, still looks to be very, very shaky. So I would like to take a somewhat more cautious view, at least for companies which is more urban India centric. In case of rural India, the story is significantly different, I would tend to say, especially in areas or in case of businesses which are more local supply chain centric, catering to more non-discretionary services. There, the story might be relatively different. But if I go by what is happening in case of urban consumers' confidence level, the picture is not great. Just to summarize one or two numbers from some of the very reliable surveys, for example, the RBI survey. If I see about 18 months back, the consumer confidence index, what used to be around 100 or 100 plus, the net summary indicator. In the beginning of the lockdown, which had come down to somewhere around 85, then moving to 60. Today, it stands actually at sub 50 levels. So where it used to stand about 18 months back, compared to that number is not even half. Today, when consumers are asked that how many of you will be increasing your spending on discretionary items, 72% of urban consumers say that they will not increase their discretionary spending over the course of the next 1 year. Even at the peak of demonetization, this particular number used to be 42%. So there has been quite a bit of stress so far as consumer confidence is concerned. But having said that, I would tend to say that there is a bit of upside surprises in some of the pockets. That's why in the next 1 or 2 rounds, this particular indicator will remain very, 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 very important. Rural India is providing a lot of support. Hopefully, there will be more policy support also focusing rural India. That might actually lead us to some kind of better recovery and more balanced recovery. So not that I am very pessimistic, but I would like to be cautious so far as betting putting a lot of bets on urban consumers spending.
No, in fact, you're right, Mr. Sanyal. Company after company's numbers have shown that urban spends have not really restored. It is tier 2, tier 3 cities and rural spends which are pushing up companies. The only issue is that in the overall, pie, their contribution is relatively smaller. So you don't know how much the demand is going to sustain. Mr. Bagga, let me come to you. The picture is so blurry right now. If you look at the consumer confidence index, it shows things are not great. But then if you look at an indicator like online sales, they're ridiculous numbers. Spends are there. People are going out in urban areas. If you go to a mall or a restaurant, people are going out and spending. And it's difficult to really gauge where it's at. Do you think overall that corporate numbers is an authentic sort of gauge to see where the recovery trajectory is?
The listed space is very small with respect to the economy, Tamanna. You look at the millions of retailers who are suffering, none of them is reflected in the listed space. You have the big retail 5-6 companies and the e-commerce players whose sales we are able to gauge, but the rest of the retailers we are not. The hundreds of thousands of restaurants, 40% of which have gone bankrupt and might not come back. Those are not reflected. The commercial landlords who are seeing deferment of rentals, those are not reflected. We have about 2.5 REITs in the country which are showing up. But you're not really seeing a very true reflection. So Three big points, Tamanna. Why is the economy and the stock market divorced? Exactly the reason what you have said in this program so far. The earnings in the listed space have held up, but they are very small vis-a-vis an economy which is 60% run by SMEs who are not represented in the stock market. Second big part is it's a K-shaped recovery. It is a V for certain sectors. Manufacturing is back to 85%. Services are not even 40%. Railways is not even 10% in passenger traffic, Tamanna. And railways is a huge part of the services. So your telecom is doing well, e-commerce plays are doing well, digital is doing well. But there are huge pockets. External arrivals are down to zero. So tourism, travel, hotels, retail, there are so many sectors which are the lower part of the K, which have gone down and stayed down. So I would not be so optimistic. Third big part. So first part, listed space is not reflective of the economy. Second, K-shape. Third part, if you look at the government finances, they have not overspent. So where is the stimulus? The revenue expenditure is very much in line with the budget because you have cut down in other places or you have done smart accounting. The capex of the government is not showing any increase. So where is the stimulus? It's not there. Whatever stimulus is coming is in the external market. Secondly, the monetary policy stimulus. RBI cutting the 115 basis points and the overhang from last year. That has helped. That has helped the bank's treasury gains. But as you mentioned, NPAs have got postponed. We really don't have a look at it. 3 months back, we knew 75% of developer loans are in restructuring. Now we don't have any idea because everybody is saying August 13th, Supreme Court told me you can't recognize NPAs, I have stopped. This is one of the most catastrophic policy actions in this country where you have stopped recognizing the NPA. So today, as an analyst, you don't know what is the true condition of the books of the banks. The good banks will tell you what it is. The large portion who don't have such better technology tracking mechanisms, you will come to know 6 months, 9 months down the line. I think that is the bigger thing we should see. Rural is recovering. Rural will carry some part of it. Auto, we are seeing a stagnation. There was a catch-up, but already October numbers are not looking that hot. The CV numbers have never come back more than 50% of February. You saw the CV results today, CV financiers not doing so well, Tamanna. So a lot of weak parts. I would say K-shaped recovery, lot of work in progress. Yes, instead of -24, we'll go to -12 in the last quarter. And then in the December quarter, we'll go to -6. But we are not seeing a +30 like the US because there was a stimulus put in there. We have not had any stimulus. It is just accounting which has happened.
You know, you have some excellent points there, Mr. Bagga. I would find it hard to argue with those. Siddhartha Sanyal, I want to come to the point of extrapolation. Mr. Bagga makes the point that Nifty 50 companies are bellwethers, but they're not necessarily representative of Indian business on the whole. Do you think that, there is merits to that argument? Can we stretch this and say that, hey, maybe things are better than was expected for a larger pie of companies?
Well, I think that there is a very, very, very interesting situation which is developing. In case of some of the very large companies, the story seemed to be pretty nice. In fact, what we have found that in case of some of the very small, tiny companies also, who are typically linked to the absolute local supply chain and catering absolutely non-discretionary stuff, for them also things are improving very significantly. But this particular segment is not a huge segment. There is another huge segment which is in the middle, which is possibly struggling a lot more. And there it's very unclear when they will really be bouncing back to normalcy. In fact, again, for all these segments, for all these somewhat small and very small segments, if you are more rural focused, more non-discretionary items at this juncture, I would tend to think that you will be doing much better over the next 3 months and 6 months as the movement related uncertainties will gradually and expected to be tapering down further. But if you are not, if you are linked more to the urban system, or even more complicated, if you are more linked to the global supply chain and value chain, then possibly uncertainties galore. And also another very important point, everywhere these days we hear this discussion about a V-shaped recovery. If you look at the numbers, just number and just statistics, you will possibly see a perfect V. But you will see a perfect V not because your recovery is dramatic, because the fall was minus 24%. That needs to be kept in mind all the time, and that's why all the recovery numbers need to be interpreted very, very carefully. In fact, we are factoring in, a non-positive growth numbers for all the 4 quarters in this particular financial year. Next year, we are talking about a high single-digit growth rate. But even after that, our FY22 GDP growth numbers are 12 percentage point lower or 12% lower compared to where we had been projecting it in the pre-COVID scenario for FY22. So that's the extent of the damage this particular year has done. Again, the big point is that the damage has been very different. The scale or impact of the damage has been very different compared to sectors and segments. But no point denying that the damage is very significant and will take a long time to recover from there.
Absolutely. Mahantesh, so would it be safe to say, when you talk about this K-shaped recovery, that it depends on the sector? Tech is looking stellar, irrespective of base effect, irrespective of COVID, and perhaps because of COVID has really seen, wind beneath their wings. That may not be the same story in other spaces and other sectors.
You are right, but the point here is that when we rattle off all these statistics, when we say that real estate is not doing well, when we say restaurants are not doing well, or when we say that we dipped 24% in the first quarter, markets actually are not backward-looking. These are all backward-looking kind of numbers or backward-looking kind of statistics. Market is always forward-looking. So when you look from a forward perspective, there is a lot of recovery that is likely on the cards. And some of these large companies may be doing well on their own account, but are having linkages across a supply chain, which is pretty large. After all, the market cap to GDP of our country is now closer to 100. Or 1, if we were to measure it in ratio, it's 100 when you measure it in percentage now. A couple of years ago, it used to be in that 80s kind of range. Now, if the market cap to GDP is coming towards 100, it does tell you that there is a huge potential for economic recovery when large companies move. When the large companies move, they indeed move the needle. If a Reliance comes up with stellar results, posts a strong recovery, it lifts up a substantial portion of the economy. If an HDFC Bank reports a 22% increase in balance sheet size, it lifts a significant portion of the economy up. So when Nifty companies are pretty large companies, I would say. Gone are the days when Nifty companies would be pretty small in terms of their size of operations. Today, they are in reporting revenues in several $1 billion, I would say. And therefore, when markets look from a forward perspective, all these statistics that we are talking about the past, damage done is to be forgotten. Actually, past is past. You have to look forward. So from a forward-looking perspective,
that's a whole, Mahantesh, I will have to say that's a whole different discussion. Yeah, no, what markets are looking at and what are markets betting on, and if that's really in touch with what's happening in the Indian economy and with the finances and experiences of the Indian people is a whole different debate and a whole different discussion, one which I think we should revisit sometime soon. But for the moment, I'd like to thank all of you and wrap it here just with the note that yes, there are definitely signs of optimism and hope with the recovery that we've seen in Q2. After a terrible Q1, which was expected, Q2 has seen a sharp recovery. But remember, it's on a lower base, and we will have to see whether it goes beyond pent-up demand and whether it can be sustained. At least the beginning is good. Thank you so much to all of you for joining us on debate number 1 on the show this evening.